Hello everyone, happy planning. Every retirement article tells you the same thing. Split your money into bucket and you will never have to sell it in crash. It is sound smart. Almost nobody tell you actually tested it properly in 2023 and found that bucket strategy leave you with less money than if you would done just nothing fantasy at all. So today I'm going to teach you the bucket strategy properly. Particular video, what I will do is I will actually compare this bucket strategy with 3% rule. Okay, 3% withdrawal strategy of retirement. So in a way, I'll cover both the strategy and both the methodology. So here, what we'll consider, the person who is retiring, he actually has 2 crores of corpus. Every year, he needs 6 lakhs. He was, and per month basis, actually, so if I convert into per month basis, 50,000 per month. So here the red line is no bucket 3% withdrawal strategy. And here the yellow line is 4 bucket strategy. So in this particular 4 bucket strategy, we'll distribute your investment, your retirement corpus into 4 buckets. So one bucket would be cash, the money which you need, liquid money, every yearly basis. That particular we may so every yearly basis you need to use this particular thing. So here you may consider maybe 6 lakhs or 10 lakhs you can keep over here. Second bucket is debt. So here debt, and if you are retired, maybe you can consider keep senior citizen fixed deposit, as you will get a better interest rate over here. So in this debt bucket, you may consider debt or senior fixed deposit. These 2 bucket put together, you should have 3 years of your actually whatever the expenses. So what is happening? First year you need in your cash and another 2 year. Okay, that means 6 and 6, another 12 lakhs you should keep in this particular debt bucket. Okay. Now third option is what I have introduced over here, the bridge between safe and the equity, most volatile and high risk, high gain sector. Okay, it is called multi-asset and balance advantage fund. So, who understood finance well, asset class well, so they know ki in multi-asset fund, there would be 3 or more asset class, which we have explained in our earlier videos. So in this particular 3 and more asset class, we have equity, we have gold, we have bond over here. And this particular approach is more into little bit of passive kind of approach. Okay. And some fund, they use REIT as well. Along with that, we just add one more concept called balance advantage. In this balance advantage concept, what is happening here? We'll have debt and equity. So based on market volatility, market valuation, our fund manager, they actually do the rebalance between debt to equity. It is a bit passive kind of strategy what basically I use for my client. So it has its own reason. And the reason actually in our last video, you may see when last 2 years equity was not performing and equity has higher standard deviation with lesser standard deviation, this particular because of gold exposure and debt exposure, this multi-asset actually has performed well and it has given very good return. So that is why we keep middle layer as multi-asset, and the percentage and allocation, it depends based on lot of factors that when we do personalized discussion, that point of time we discuss. Okay. Now the fourth bucket is equity. Okay. In this particular bucket, this is the growth bucket. Now, here, this is the highest growth bucket, and here standard deviation is very much into higher side. For example, illustrative purpose, what we have kept over here, 9% is into pure cash, 18.6% into debt, 13.3% into this multi-asset and balance advantage bucket, and 58.6% is into equity corpus. But why I just kept we kept this particular thing to do the simulation and the calculation purpose. But friends, here depending on lot of factor, this allocation should change. That is why personalized plan and tracking is very much required. So the bucket strategy stops you in panic selling exact the wrong moment. So let me show you what is actually it looks like. What is wrong moment? Say for example, last 2 years, equity is not giving that much of return. So if anyone has retirement, okay, so last 2 years they may use their cash, they may use their debt. First they may use their cash, then they may use their fixed deposit or debt. Once it is over, then as I show you in my previous video, multi-asset has given 15% kind of return. We may do profit booking from multi-asset, and we may use this. And third resource, we may use this direct equity. So if maybe say for example, if you use this complete these 3 resource, and maybe these 3 resource completely they are sitting in around maybe 50% of your portfolio. So then it is around 1 year. So if it is 1 year and every year you need maybe how much? 6 lakhs. Then 10 years it is like how much? 60 lakhs. Okay. 20 years is 1.20 CR. Okay. So we have that much of time to perform this equity bucket. Right. So I ran all 4 buckets in real 30-year simulation, starting from actual 2008 crash. Nifty down 51.8% in year 1 of return. What happened? Total portfolio 2 crore become 1.39, and no one knows when market crash happened. I just compared 2 strategies. One is 3% withdrawal strategies. But as you are at your retirement, you need regular income, right? So in both the strategies, I need to take out and give it to you money, right? So what had happened? So here every year when you withdraw, means that 6 lakhs every year. So this point also you have withdrawn 6 lakhs, and here also you have withdrawn 6 lakhs. Because this is your day-to-day expenses. No one actually it should not be stopped, right? So see what happened in this 3% withdrawal strategy. So I need to take money from my equity as well because it is automated. So for that reason, what had happened? The initial stage when this particular actually erosion happened in my overall portfolio. So at the end, actually when this 30 years completed, actually this particular strategy left over only few amount. Okay, while I have whom I have given bucket strategy. So while in this particular period when market is down, this particular point of time, I am using my cash and debt bucket. Okay, after 1 or 2 years when market picked up, okay, and we see and this particular 1 or 2 years we did not touch our equity portfolio, and after 1 or 2 years when market picked up and we saw significant return on equity, That point of time, we touched our equity bucket. We did our profit booking from equity bucket, again realign our portfolio as per our that point of time, as per whatever the necessary percentage it is required. So now let's summarize this particular slide. Both strategies survived the crash. That's the good news either way. But look at year 30. Someone who actually used 3% strategy, his portfolio was left over with 42 lakhs only. Bucket, 4 bucket strategy, actually it is ended with 3.74 crore, 9x more than 3% strategy. Here, it is not purely the physiology talking. So now let's understand how actually it runs. Here, it has 3 pillar rules. Discuss with your wealth manager and try to understand what would be the percentage. Okay, depending on your years and depending other factors, like what is your actual need, one factor. What is your time horizon? Okay, all those things. Okay, so just try to understand that particular thing and decide one percentage. So how much percentage you need in first bucket, how much percentage you need in second bucket, how much percentage you need in third bucket, and how much percentage into fourth bucket. So what you will do is, whenever equity is doing good, okay, that point of time, you need to fill your other 3 buckets. Okay, other means 2 bucket, it is very much mandatory. The first 2 bucket you need to fill it. Okay, and third bucket is it create the balance. Okay, this is one part. Second part, maybe you are a bit aggressive and it is the time when you understood yes, you actually market is down. So what you may do is, and if you have clear visibility, keep for your maybe 2 to 3 years, means how much amount is needed. Apart from this, if you have some surplus cash in first 3 bucket, that point of time you may rebalance it into equity. Okay, if you rebalance it into equity, what would happen? You again purchase in lower base. Okay, so when market will come back to your actual position, and when it goes up, so your money will grow faster. Okay, so all those things are there, but that is why you need to sit. That is why personalization is very much required. You need to sit with your wealth manager. 2, never sell equity or multi-asset in down years. So say for example, if it is overall level down, economic level down, that means like COVID or something like actually where my multi-asset also down, my equity also down. Okay, that particular scenario comes very rarely, because what happened, if equity is down, it might be some alternative asset class, might be debt, interest rate is high, debt is giving higher return, or against equity, against hedge is gold. So gold maybe go up, gold maybe is into upside. Okay, so that is why you should never sell when equity and multi-asset both is down. But normally it is seen multi-asset and actually this balance advantage with lesser standard deviation give a decent return. But yes, obviously we should not compare with only 100% equity kind of growth. Okay, when that growth has come. But this is more into risk management perspectives. And one more thing we can do along with these things. So we are using this bucket 1 or 2, bucket 3. From bucket 3, we may start SWP as well, because that's out of 6 lakhs, whatever money you need, out of 6 lakhs, because this particular bucket is very much balanced kind of bucket, right? Because of multi-asset approach and lesser standard deviation and all. From this balanced thing, we can start giving that SWP. Okay, so this is one thing. And apart from this, and whenever it is required, we can do adjustment from bucket 1, 2, and bucket 4. So number 3, review yearly. So what I would say, review periodically. My answer is you read the theory and understand what circumstances that particular theory is used for. So, but use your brain in your own country perspectives and your own data perspectives. So what is useful for another country, another situation, another inflation rate? Maybe it may not be actually relevant for our country, our situation, our interest rate, and our inflation rate. In this 4 bucket, you can start adding one more thing. It is called international equity. So, but don't blindly follow one country. It is like one-way rally you are seeing. Don't blindly follow that. Maybe you need to sit with your wealth manager first. Try to understand some good mutual funds. Why I am talking about mutual funds? Because it is for few people, it is very much difficult to pick right stock at the right time and do their forensic and all those things. It is very much difficult. So maybe some fund manager who has very big bandwidth, like maybe big brand and their fund managers. So that is why normally I prefer to go with in international equity. I prefer to go with mutual funds. In fact, compliance perspectives also. So direct equity, when you do direct equity, compliance, taxation perspectives, lot of hassles are there. So it's like you are trying to go and save small things and you are paying very big things. When to do profit booking, from which bucket to which bucket we should do profit booking, how to do profit booking. For that, you need to understand how asset class work, how market cycle works, how risk management works, how hedging works, etc. And honestly speaking, maybe this particular system leave you with little bit of less money, but it is fine in risk management perspectives. Friends, hope you understood why bucket strategy is one of the very good strategy in retirement perspectives and as well as in lump sum perspectives as well. Okay. So, so if you are working and you have different altogether retirement plan, so it has a different strategy altogether. So this particular strategy is more relevant for retirement kind of perspectives. And you also understood why personalization is very much required. Yes. So friends, for data-driven personalized solution, you can contact me in below given number. So I would be happy to help you out. It could be video conferencing like this, or you may come to my office as well. This is not personalized recommendation. So this example is for illustrative purpose only. Equity investment is subject to market risk and mutual fund investment as well. Please read all the document carefully before investing. Planning does not mean it is 100% successful. Planning is a tentative things, is a roadmap. It's like a broader roadmap. So we are going into which direction, and everyday market is changing. So when we know our broader direction, definitely that point of time, we may take our first step in right direction. Over the time, that is why regularly in different interval review is very much required. And along with you, someone should be there who can track your portfolio. So in my case, actually, I track my client's portfolio from backend. Hope by this particular video, I can able to add some value to your life. Thank you. Happy planning and have a nice day.